To me, there are no signs of a mania at the moment, no signs whatsoever. Gold has been going up for the last 3 years, not because of traditional economic factors. We may well get a situation where rates do not come down anymore, but at the same time they introduce QE, and that QE would be wildly bullish for gold.
Adrian Day returns to the show. He is the president of Adrian Day Asset Management and the portfolio manager of the Euro Pacific Gold Fund. What should investors do with their gold and gold mining holdings right now? We'll find out with Adrian. Good to see you again. Welcome back.
And good to see you again, David. Thank you for having me.
So, there will be some rhetorical questions this interview, but some more practical ones as well. We'll start with the practical ones. Adrian, let's start with the fact that the market has seen some profit taking from gold at $4,400 now to $4,000. The same thing has happened with the GDX. Are you participating in any profit taking right now with any of your own investments in the gold industry? Let's start with that.
Yeah, well, we're not doing profit taking now after the decline. The only profits we're taking now are in things like Probe, which has just been taken over, or there's been a takeover agreement with Fresnillo. But other than that, no, we're not profit taking. Over the last few weeks, I had been raising a little bit of cash. You never raise enough, but I had been raising a little bit of cash. So frankly, my position right now, after gold, as you say, has come from 4,400 to 4,000 and the GDX is down, I don't know what, about 12%. My position right now is for people who are reasonably fully invested, like a gold client who's got 80% invested in gold, or a conservative account who's got his full allocation in gold. We are not adding to it right now, because I think it's a good idea to always keep some money in reserve in case the market goes down more than you think. But if we've got a new account, or someone who's added money, who's underweight, we are definitely taking advantage of these declines on the buy side. We're buying.
The idea that the GDX, though, has fallen, let me just pull up a chart here. Let's start with gold miners first. The fact that the GDX has fallen 15% from its highs. Some might say that's a buying opportunity if you're bullish. But on the other hand, some might point to the fact that this looks an awfully like what happened at the beginning of the last bull market end, which was 2011. Now, this chart only goes back to 2007. But as you can see here in 2011, the charts stayed choppy sideways for quite some time, for a number of months before December all the way to June 2011. September, it wasn't until basically September that the GDX topped, and then we had this multi-year decline. And right now it's kind of looking like there's some oscillation, and people are just concerned about whether or not this is the top. I've talked to miners, I've talked to people in the industry, and there seems to be a lot more prudence, or I guess a bit more skepticism now about the bull rally than what they told me was going on 15 years ago. I wasn't around the industry, but people were saying the industry was doing a lot more M&A. They were just buying deals left and right, and then speculative money went away just overnight. And now people are being a little more cautious. So I don't know if you're seeing the same thing.
Well, what you say is really interesting, David. This is a big topic. I'll try to be brief. So number one,
sure.
If you look at gold itself, look at gold and look at its performance. There's no question in the last 2 months, gold had gone up too far, too fast. It had been, I like to say it was overbought but underowned, but it was clearly overbought. It had gone up too far, too fast. But look at a long-term graph and look at it in a log term. Look at it in a percentage term. This rally over the last year and a half in gold is less than the 2010-11 rally, and it is less than the 1979-1980 rally. So
Yes.
this rally, however dramatic it seems to us now, and of course going up every single day for a month and hitting a new milestones every week, made it seem like it was unprecedented. It was not unprecedented. In terms of percentage move, this is less than 7980 and less than 2010, 11. So that's the first thing I'd say. The second thing I'd say is that the gold stocks, although we're up over 100% year to date, they were up over 100% year to date, they still had not exhibited the traditional leverage that gold stocks exhibit to gold. And they were still fundamentally cheap if you look at price to earnings, price to cash flow, price to NAV. Because of course, as the price of gold moves up, then the margins expand because the costs are not going up as much. You've got all-in sustaining costs for the industry somewhere around 2,200. Those are pretty astonishing margins. And of course, some companies have even greater margins. And so the margins were expanding, and with the margin expanding, that means your cash flow is increasing, which means your price to cash flow multiple is not going up as much as the price of gold would make you think. So the gold stocks were still cheap. I think the most important thing I would say relative to 2011, and you hit on it, David, or you hit on part of it, when you were saying, oh, in 2011, we had a lot of M&A and so on. And so that's a good thing. In 2011, the industry went crazy, overpaying for marginal assets. That is a classic sign of a top. We haven't had that this year. We've had a lot of a pickup in M&A, no question. But it's all been rational M&A. We haven't had people grossly overpaying for marginal assets. We haven't had that yet. And so what I would say the big difference between today and 2011 is the sentiment. So again, precisely the fact that in 2011, everyone was doing M&A like crazy. In 2011, you were getting new deals coming to market every single hour of every single day. In 2011, the GDX was trading at a premium in June, July, August, September, and that premium was growing as the market was topping out. In 2011, you had huge inflows into the GDX. I'll send you a graph afterwards if you want. But you had huge inflows into the GDX. Now, maybe at the time you could come up with rational reasons why you didn't think it was a top. Remember, Europe was blowing up at the time. Greece was bankrupt, and people were thinking it might be the breakup of the euro. I'm not arguing that. I'm just saying that there were signs of a mania, signs of a manic top, which we don't have today. Look at the GDX today. You had a couple of weeks of inflows in October. But you go back 2 months, 3 months, 4 months, 5 months, and it's net outflows. Over 3 billion of outflows this year to date. GDX and GDXJ combined over $4 billion of net outflows this year. And you saw a little bit of an increase in flows, as I say, in the beginning of October, but nothing dramatic. Look at the premiums. You had teeny-weeny premiums 1 or 2 days, but you didn't have what we saw in 2011, which was a rising and steady premium for weeks, or months, I should say, ahead of that top. To me, there are no signs of a mania at the moment, no signs whatsoever. And if you look at the GDX and see over 3 billion of outflows this year, that's people selling, David. That's not people not buying, that's people selling. If you have those sort of outflows and you don't have inflows, you don't have public participation, because who does the public buy? If you're not a gold expert or a very sophisticated investor like Ray Dalio or something, what do you buy? Maybe you buy Newmont, maybe you buy Barrick, but you probably just buy the GDX. And so if the GDX is not getting inflows, you don't have any public participation. You cannot have by definition, you cannot have a manic top without public participation. We haven't had it. So I don't think the parallel with 2011 or 1980 holds up at all. I understand people being concerned because we've had these rallies before 2015, 2016, 2018, 2020. We've had these rallies before, little rallies where it's gone up and then come back again. It's not unusual to have corrections mid-cycle. I don't even have to go back to 1974, 75. We're in a space of 10 months. Gold dropped 50%. 50%. Go back to 2006, where gold is back 30% in a week. Who remembers that anymore? Who remembers that? I'm sure at the time people were asking, is this the top? Is this the top? But anyway, I just don't think there's any indication of a manic top at the moment. It's just a pullback.
Silver has been one of this year's top performing assets, climbing more than 80% year to date. Importantly, it hit its much anticipated $50 an ounce historical high, which has only happened twice before in its entire history. The whole silver market has been in a frenzy all year, but physical bullion is not the only way to be exposed to the metal. I'm here to tell you that today's sponsor, Kootenay Silver, has a great leverage to the silver price. Kootenay has a leading growth profile highlighted by one of the largest junior-owned silver asset bases in Mexico. The company has a 50,000-meter program underway at the high-grade Columba silver property to advance the current resource of 54 million ounces at 284 grams per ton silver. Kootenay is also holding over 200 million ounces in the measured and indicated categories and over 100 million ounces inferred at the company's Promontorio and La Cigarra projects. The company has an experienced management team with a track record of success from exploration discovery, finance, to production. If you're looking for a company that will leverage the potential gains of the silver market, do your due diligence on Kootenay Silver. That's ticker KTN on the TSXV. Just on the notion of the fact that you bet that the fact that the gold miners aren't spending as much money on M&A now as they did in 2011, you can look at it two ways. One, they're more disciplined now, or two, they don't have the cash to execute on M&A deals, even if they wanted to, which is true.
Well, David, you know the answer to that. You know that the GDX is net cash positive, the GDX. Now, yeah. that includes Franco and Wheaton, which have a lot of cash. Royal, of course, has 1.4 billion of debt, but nonetheless, it includes Franco and Wheaton with a lot of cash. But the GDX is net cash positive. That is an astonishing for a capital-intensive industry. That was not true in 2011. And so, no, they've got the cash. There's no question about that. I think there's still discipline in this industry. Will it change? Who knows? I'm sure at $7,000 or $8,000 gold, it will change. But right now, there's still a lot of discipline. They have the cash. Most of the excess cash flow. I hate that term, excess cash flow. What's excess about cash flow? The more the merrier, right? Let's call it free cash flow. But the free cash flow has gone primarily to paying down debt over the last 2 years, which in my mind is absolutely the right thing to do, to pay down debt first. But no, most of the miners have no debt at all. Or if they have debt, they are still net cash positive.
When you say there's no mania, let's evaluate the fundamentals of gold. So in the past, gold has moved on, let's say, a lower dollar, or in some cases, a lower real interest rate. In some cases, the 10-year yield dropping significantly with the long end of the curve, or inflation expectations going up. Now, most of these things are not really happening right now. Inflation expectations have risen somewhat, but if you were to look at my screen now, Adrian, I can just show you gold versus the TIP ETF, which is an ETF that tracks the Treasury Inflation Protection Security, which is a proxy for inflation expectations. Year to date, gold has moved a lot more. If you just zoom out, you can start to see this divergence. They move in the same direction, but gold's just moving much more than inflation expectations are going up. The dollar, as you know, has gone down a lot this year. That may have contributed, but if you take a look once more at gold versus the dollar, once again, you'll see that the dollar kind of stayed flat after its big decline post-March, yet gold kept going up. Real interest rates actually are going up, not down, and they've held an inverse relationship in the past. So it looks like gold is defying a lot of the fundamentals that have driven up the price before, and people might look at this fact, Adrian, and say, well, clearly gold's in a bubble because it's diverging from its fundamentals. How would you respond to that?
Yeah, I'm not going to say this time is different,
Yeah.
because Templeton said they're the four most dangerous words in the investment lexicon. Let's just say there are some differences this time but last time. So normally, and everything you said is absolutely true. And if I may, it all points to supporting my fundamental thesis on gold and gold stocks, which is that gold has been going up for the last 3 years, not because of traditional economic factors, right? So we know who's been buying gold. It's the central banks, it's the non-official Chinese, it's wealthy families in the Middle East concerned about fiscal deficits around the world and instability. And those buyers are all of those buyers I just mentioned, but particularly the central banks and the wealthy Middle Eastern individuals and families are, if not price agnostic, they're certainly price inelastic. They are not buying because they think, wow, this is a great time to buy gold. Look at the chart. There's a cup and handle. There's a this, there's a that. And we might be able to get a 20% move in the next 12 months. They're buying for insurance. They're buying for defensive reasons. They are not, and we don't need to go into all the reasons. We know why those different people are buying. But the point is they're not buying for the traditional economic reasons that people have bought gold. Now, North American investors, because we've never had that experience of actually needing gold, the experience that China's had when the people fled to Hong Kong, or the experience that Germans had after the Weimar Republic, etc., etc. Because of that, North Americans typically don't buy gold as a defensive asset. Some people say they do, but very few do. They buy gold when the economic scenario is conducive to gold. And that means a weak economy, high and rising inflation, low and declining interest rates, and a falling dollar. And that is precisely the opposite of the environment that we've had for the past 3 years. Or I should say, it's the opposite of the narrative around the economy that we've had for the past 3 years. So, if I may, at the same time that central banks around the world, Chinese non-official sector, wealthy families in the Middle East have been buying gold for their own reasons and buying gold regardless of price, North Americans have not been buying gold because the environment has not been conducive, right? And that's the reason that the gold stocks have lagged. When I say lagged, they haven't lagged in percentage terms, but they have not exhibited the leverage to gold that they normally exhibit. Because there are other buyers of gold pushing gold up higher than it otherwise would move purely on economics. And B, because North American investors, ordinary everyday investors, have not been participating, and they're the people that buy North American gold stocks. The Central Bank of Poland doesn't decide whether to buy Newmont or Barrick. Mrs. Wang or whatever in Shanghai, she doesn't say, I'm worried about the banking system. Let me have a little piece of Agnico today. No, so they don't buy stocks, they buy bullion. And so I think what you argued, which is all true, is precisely why I'm saying that the public has not participated, why we're still closer to the beginning of this move than we are to the end. When the economic scenario in the US changes, and we can talk about that if you want, but let's just say when it changes, as it clearly is, the dollar had the strongest first half decline this year, and even though it hasn't gone down much more, let's just say the first half decline was the largest first half decline in the dollar since 1974. And even though it has not gone down much more since then, we can agree, I think, that the recovery rally has been very, very anemic. So you've got a weak dollar, relatively weak dollar. You've got an economy that is clearly showing signs of weakness, particularly on the labor front. If even Jerome Powell, who 2 months ago said the labor market in the US was solid, if if even he is thinking that there's weakness there, there's pickup in inflation. At the minimum, we can say that inflation has not been conquered. Inflation remains not only above the Fed's arbitrary target, but it also remains above where it was for the 5 years before COVID, which was a spike in inflation. And of course, interest rates are moving down slowly, stubbornly, but they're moving down, they're not moving up. And so the economic scenario is changing to one, the North American economic scenario is changing to one that is conducive for gold and gold assets, in my view.
I think it's just precarious part of human nature to always find a reason for why things have happened. But here I am looking for a reason for why this massive rally happened this summer. Everything you've talked about, Adrian, has happened over the course of several months, if not years. It's not just overnight inflation happened, or overnight the labor market weakened, or overnight we've had a deficit and debt rising. Look at the gold pricing, the gold price rising from 2024 all the way up to the beginning of 2025. It's up already 70% before we had another massive move early in the summer. So remember, recall that gold stayed relatively flat around $3,400 from April to August. And then we had this parabolic move. I mean, if I were to push you to explain what all of a sudden drove it up in a matter of weeks, what would that be? Because like you said, all these changes happened over time, and it would make a lot of sense if gold just steadily rose over time. But it seems to have happened all very suddenly. Now, one could argue that this is just a consolidating pattern. This was just a longer bull rally, and it did gradually rise, but it still happened. I mean, you look at it, 114% over the course of a year and a half. It's rather sudden for gold standard, right?
No, absolutely. Well, first of all, I think you are 1000%, if such a thing exists, you're absolutely correct in saying, that as humans, we're always looking for an explanation. We think there has to be a fundamental explanation, or if you're a technician, there has to be a technical explanation. But and it sometimes amuses me, frankly, when I look at headlines. You'll see on Bloomberg, or not to pick on Bloomberg, but at 11 o'clock they'll say gold down because of interest rate fears, and then at 12 o'clock they'll say gold up because of interest rate fears. I mean, markets move up and down, right? Especially in the short term. And sometimes, frankly, and I don't know if this is what you were driving at, but sometimes there really is no specific explanation. Sometimes markets, rallies, they just die of exhaustion. At 4,400, after that kind of rally, even the most dedicated gold bull was probably saying, I think I'll pull back and wait for a week or two. A market a bull move dies of exhaustion, when there's no more people willing to pay those higher prices, not willing to pay those higher prices at that time. So there doesn't always have to be a reason. I mean, if you want what happened in the last 2 months, well, it wasn't a huge increase in central bank buying. We know that the last month we've got numbers for, or the last month we've got comprehensive numbers for, are August. And in August, central bank buying was up on June. There was a pause in a couple of months, or slowdown in a couple of months before that. But that's August. So did the central bank suddenly resume buying in September, October? I don't know. I have no reason to think they did. There's nothing to suggest they did. If you look at individual banks that have reported, there's not a huge spike. There was a huge spike in Chinese non-official buying. That became a little bit of a mania. So a huge increase there, and you can see that by the premiums on the Shanghai Exchange, by the lines outside jewelry shops, by the pickup in imports, which come through Hong Kong. So you've got numbers. You don't have numbers on how many ounces were bought by, Chinese consumers, but you do have indications that suggest that there was a huge spike from that source. But I mean, clearly it had gone too far too fast, and it was just waiting for a pause. And again, the pause, when you think about it, wasn't caused by anything. I mean, we had the Gaza peace deal, which was 2 weeks before gold peaked, and it was actually beginning to look as though it might fall apart the day the gold topped. You had China and Trump at it that week. So there was no reason for it to decline because of, now it's changed, that scenario has changed. But so what I'm saying is I don't think there were any fundamental reasons why gold went up the way it did in October, September, October. And I don't think there were any fundamental reasons why it stopped going up on the 19th or 21st or whatever the date was.
Let's go back to miners. I had a guest on my show who said that he doesn't like gold miners because no matter how far the gold price runs up, miners always find a way to lose money. Can you just comment on that? The margins right now, how are they doing?
Well, don't tell me who your guest was because I might insult him.
No, I won't.
If I don't know who he is, I'll insult him. Well, maybe he was just buying the wrong stocks. Can I just say that?
Probably. Yeah, that's possibly. Okay.
Even Barrick's up 100% this year. Newmont's up. Even Newmont's up. Agnico's up. Kinross is up. Anglo Gold is up. They're all up 100%.
Yeah, so, but are they up because of better company performance or just because the gold price is up? I think that's the point this guy was making is that,
I'm sorry.
These margins are margins are great. Yeah.
If you're a miner producing gold, then the gold price is the number one determinant of how well your company does. No question about that. Just as if everybody suddenly stopped eating and living off air, Nestle would no longer be a very good company to own. So there's no question that the price of gold the price of gold can forgive a lot of sins. And in a bad market, there's only so much any company can do. But I don't think you can, I honestly don't think you can say that it's all, no, I don't think you can say that it's all a gold price at all. I mean, you look at a company like Agnico, which is, obviously the gold standard. But you look at a company like Agnico keeping costs, well, most of the companies, but keeping costs well under control, a little bit up in the last quarter, but down in the quarter before. Very, very disciplined. No, I don't think you can say it's all a gold price. But clearly, if gold goes back to 2000, all of the gold stocks are going to drop.
All right, so that goes back to the fundamental question of how you pick a good mining company. So yes, the gold price is up. Some outperform others. How do you pick the outperformers? What are the outperformers doing that are helping them maintain better margins, for example?
Well, no, that's a good question, and I think I think you have to ask what you're looking for. If you're looking primarily for beta, you want to buy something, you want to own something that will go up if the gold price goes up. You're going to buy something different than if you're looking for alpha. I want the maximum return. If gold goes up, I want the maximum return. You're going to buy something different if you want the lowest risk return, et cetera, et cetera. So, I mean, I think an awful lot comes back to management and history. If you look at what management has done in the past, let's face it, all of them, pretty much every, well, that's not true because Newmont and Barrick both have new management. But the management of most of the companies today, they went through the COVID period. Let's just look at how they did during COVID. We don't even have to go back, 20 years to see how they performed in a bear market. Just how did they perform during COVID? What decisions did they make? So I think the key is to look at the management and what their track record is. And there are companies, whether it's Agnico, whether it's, smaller company like Fortuna, companies that have just an extremely solid track record of financial discipline, not overpaying, buying at the right time, keeping a strong balance sheet, not over levering, not going crazy on acquisitions, having good mine performance. I mean, good mine performance is critical because you can have a mine and I wouldn't be able to run a mine. I don't know about you, David, but if you put me in charge of the best mine in the world, we'd be losing money pretty quickly, pretty soon.
Sure.
But some teams like Agnico, like the Fortuna people, have proven themselves to be very, very good at operating mines and getting the most out of those mines.
Some people have asked me personally, I own some gold or precious metals or silver. Now that gold has run up a little bit, I want to take some profits and allocate more to other assets. Should I take some of that and buy some miners? And that got me thinking, your portfolio allocation of bullion versus miners, does that change when the price of the gold runs up considerably? In other words, we're in a bull market or a bear market for that matter. Does your allocation change, and if so, how?
Oh, definitely, no question. I mean, first of all, I think people should have some gold that is more or less permanent as a defensive position, as an offset as a hedge on the rest of the portfolio, and so on. So we're not talking about that permanent insurance position. If you've got gold as an investment, depending on when you bought it, of course, you have done better than you could rationally expect to do from an inert substance that doesn't pay a dividend, right?
Yeah.
As its detractors keep telling us. And I think it is definitely, so what I would say is definitely this will be a good time to shift, meaning to sell some of the gold bullion or gold ETFs and move it into the miners that are on a historical basis undervalued relative to gold. So the gold stocks are undervalued relative to gold. Now, you could go further and say, if you look at other commodities like copper, natural gas, oil, you could argue that those are even more undervalued relative to gold because they've hardly, I mean, even though copper's basically at a high, but I mean, you could pick a handful of copper stocks, and even though they've gone up, they are still fundamentally undervalued relative to gold. And that's even more true for oil and gas, which of course has just been, it's been anathema to own those assets. But to answer your question, I certainly think right now would be a good time to trim the gold, take some profits. Of course, there's tax considerations. I'm not getting into that. To trim the gold and to buy the gold stocks. Some of the gold stocks are still very, very undervalued.
I want to just finish off on the Federal Reserve FOMC decision this week to cut rates by 25 basis points is widely expected. What was not widely expected with Jerome Powell's statement that the December cut is not a foregone conclusion. As soon as he said that, the chance of a cut by December on the CME Fed Watch tool dropped from 90-something% to 66%. And I wonder if, I'll let you evaluate his statement, but I wonder if there should be more hikes, or cuts rather. There should be more cuts right now, given where the economy is headed. Basically, let's just evaluate what the Fed is doing right now.
Yeah. Well, no, there were two really interesting things from Powell's comments. The second one was about the balance sheet. We can mention that if we remember.
Yes.
But I think, well, what seems clear is that there is growing dissension in the Fed. So you've got Mirren put on and Trump, on the sidelines telling him to cut, cut, cut. And there has to be some pushback among certain members on the board about that. And maybe that has stiffened their sinews, as Henry V said before the Battle of Agincourt. Maybe that has stiffened their sinews. And so now you've got 3 Fed officers come out in the last 24 hours saying they don't think there should be a cut in December. There was only one dissent, of course, on the quarter point cut that they did this week, but 3 of them have come out and said there shouldn't. And so I think what Powell was doing, he knows he's now got a divided board, right? Which is unusual for the Fed. He's got a divided board, and not only does he have Mirren, Trump's nominee, but he's got other people who want to be Trump's nominee for chairman, and they're going to obviously be on the easing side, and he's got other people who are on the hawkish side. But when you say what should they do, I mean, I think they should abolish themselves, but that's perhaps a little more radical than we're looking for right now. The problem is, as we all know, with the dual mandate, they're fighting a battle on 2 fronts, and increasingly they have to emphasize one front or the other. They cannot fight on both fronts equally without losing on both fronts, like Hitler in the Second World War. So you got to pick your battle, I think. And, is it inflation, which suggests you keep rates where they are or even move them up? Or is it the labor market that is, slowly deteriorating? People will point to evidence from the states that there hasn't been a big increase in new claims. That doesn't necessarily mean that the labor market is strong, of course, because you've also got an increase in continuing claims, and you've got an extension of the amount of time that it takes people on unemployment to find new jobs. And so if I were an employee, a dissatisfied employee, not very happy, and I look at that evidence and say, all my friends tell me it takes them over a year to find a new job, I'm probably not going to go into the boss and have a row and quit.
Yeah.
So I'm not going to show up on the new claims. I'm going to do everything I can to try to keep that position. But there's no question that there's huge layoffs. We've seen that. We've seen those announced in the last couple of weeks. Huge layoffs. UPS, or Nestle, that's mostly foreign, of course. But anyway, so the problem is that the Fed is fighting 2 battles, essentially with the same tools. And it's really got to emphasize one or the other at some point.
And I'll end on this final question. The fact that there were 2 dissents, one of them came from the Kansas City president who didn't want any rate cuts at all, highlights the fact that within the Fed, there may not be a go right ahead and cut no matter what mentality. Powell himself said that. It's not a foregone conclusion.
No question about that.
What does that mean for gold if, let's say, there's a little more hesitancy to be dovish going into 2026?
Well, remember the other thing I mentioned was the end of the QT. So
yes,
the Fed announced the QT would officially end December the 1st, but it has essentially ended. $5 billion a month on a $6.5 trillion balance sheet is a rounding error. It's essentially ended. So they are going to stop it on December the 1st, and all mortgage securities that are running off are being put back into treasuries now, right? All of the mortgage-backed securities that are running off, the proceeds are going into treasuries. What does that sound like to you, David? It sounds like to me that they are getting ready for QE again. They won't call it QE, but they're getting ready for QE again. And so we might well have a situation until Powell goes and Trump replaces people on the board. We may well get a situation where rates do not come down anymore. but at the same time, they introduce QE, and that QE would be wildly bullish for gold. Other things being equal, rates not coming down would not be bullish for gold. But I suspect that if they keep rates where they are and don't introduce QE, you're probably going to get the economy slow more rapidly than it otherwise would, which again will be bullish for gold.
I think we can end it here. Thank you very much, Adrian. We can follow up soon. Plenty more to discuss in the coming months. Where can we follow you right now?
It's adrianday.com. That's the website.
All right. Simple enough. Go to adrianday.com to stay up to date. And we'll see you next time, Adrian. Take care.
See you. Thank you so much. Thank you.
Thank you. And thank you for watching. Don't forget to like, subscribe.